Hey, welcome back to Academic Market Insights, where Dr. Ademiac and I we get a little bit more in depth on questions and issues that we hear from students about different types of topics. Where I speak to you in January of 2025, so we're both starting to teach new classes. We're also working on a case competition, and there are a lot. We probably have more topics than we know what to do with right now. But one that came up with respect to a case competition was credit ratings, and not necessarily paying attention to the Fitch, Standard & Poor's, Moody's letters, but doing some of your own work and maybe analyzing the risk of default on some sort of corporate bonds. So with that, I'm going to hand it over to Dr. A. She is the one that's she's much more conversant in this area than I am. So take it away.
Thank you very much. Yeah, debt rating is it's a tricky thing. We've all seen The Big Short, and I love their discussion when they go and meet with Moody's. And it's great because she basically says, "Yeah, I don't really review. I just take whatever was last month and just apply it forward." I'm not saying that happens. Have not had that conversation with anybody. But I think it's very important for us to understand what's really going into some of those models. And luckily, we can actually develop our own model. The advantage is we can then see where some issues are. We have a better understanding how that objective rating became. And we can even say, you know what, I don't agree with that. And this is why I don't agree with it. Dr. Rowe, what can I do for you?
I was going to ask you a question, but I really want to emphasize something that you just said, where you said that if you're looking at the credit rating and you don't agree with it, that's typically when you want to do a trade.
Yeah.
Yeah, I mean that's the big profitable trades are
Yeah.
not going along with everybody else, but trying to see something that other people don't see. Ed Thorpe, who's kind of like the god of counting cards and a few other things, I got to meet him once, and I asked him what he was looking at in the market. He was very non-specific, but he said, "I'm always looking where other people aren't." And I always thought that was a good piece of advice. If everybody thinks a bond is AAA rated and it has a yield that it matches up with that, and you think the company's getting ready to go bankrupt or there are issues there that nobody else sees, there's going to be a trade that you can do around that. And then I think both of us use the movie examples a lot in our classes. I really do like the scene that you cited. The other thing that she said that I've always locked onto when Michael Scott, the guy from The Office, he plays
Mhm.
one of the portfolio managers. When they're talking to this credit analyst, she all but says, if we don't give the companies the ratings they want, they're going to go across the street.
Right.
And that is you often in the financial world, you do need to, what are the incentives? Who's getting paid on stuff, et cetera. And with credit rating agencies, they do some good in-depth work. We all utilize their research,
Mhm.
but you always want to, you don't want to always 100% depend on other entities' research. And you're going to show people how to do your own credit rating, or credit risk analysis might be a better way to put it.
Right. And
I will
it's
stop
funny.
talking and let you talk.
Well, it's funny. Last night in the investments class, we spent quite a bit of time discussing how everything has an associated fee.
Hmm.
So, on top of what Dr. O was talking about, there are some situations where a company will be small and will actually pay to have a credit analysis done on them. So making sure that you can track all of that, I think is very important. Now, if you're looking at like an Apple, they're not paying. People are doing theirs. And yes, they are going to get paid. Moody's, S&P, and Fitch, they're going to get paid their fees through other sources. But some of these, again, smaller companies will actually pay one of these big three to do the analysis. So keep that in mind as well, too. Okay, so with that, let's get into a model. And this particular model is built around financial health. So when we think, and I'm populating this, this is a pre-built one. We can spend the time, another video actually pulling out this information from a financial statement, which I also think is a reasonable exercise. But these ratios are all really focused around coverage. Can the company cover their debt? Can the company cover their interest? Can they cover it from EBIT? Can they cover it from EBITDA? Right? So different ways of looking at it so that you can take into consideration like a non-cash item such as depreciation or amortization. And that further allows you for deeper understanding of where some of these margins are, where are some of these holes here. I like the funds flow as a percent of debt. So we're starting to look at how much debt is contributing to operating income. So debt in itself isn't a bad thing, right? We all utilize debt for different things. And it's like cholesterol, right? There's some good cholesterol and some bad cholesterol. And we want good, healthy debt that's actually generating returns. And we specifically want operations. So we don't necessarily need debt to be a huge source of financing or investments.
But
When I'm thinking about cash flows,
mm,
we want cash flows from actual operations. Sorry, Dr. Rowe, what would you like to
so
say?
that's what I was going to say is that the cash that we're looking at with respect to debt is really coming from what our core business is.
Absolutely.
Yeah.
And that gets again back to understanding the credit analysis, right?
Mhm.
Is the company able to actually make money on what they're supposed to make money on? So we even have a free operating cash flow as a total percentage of debt. Ding. Return on capital, operating income to sales, and long-term debt to capital. So this model, you can see we have last 4 years worth of data, and these analysis were done, and they were assigned by me a AAA, AA, or single A rating. And these are based on some standardized relationships. You could look at other ratios if you'd like, such as liquidity and things like that, which have somewhat standardized relationships. So like, for example, the current ratio, if it's less than 1, we know you have a problem, but you probably want to be more than like 1.01, right? You need to have some bigger numbers there. And this allows for whoever's developing these types of models to really get in there and then assign them. And this was then the final of the 4 years. What was done was just eyeballed and said, okay, we've got 3 years of AAA, the overall consensus AAA. We only had a few instances where there were some AA's and some AAA's because this was a very financially healthy company. And again, the analyst in this case then made the decision to make the overall rating a AA. This information then was transferred over to a table and then was given as a ranking. So AAA gets 3, AA gets 2, and then an average, giving a overall rating for a AA. And I cannot remember what the actual rating at the time for the company was. I wouldn't be surprised if it was a AA or a AAA, but this, as the analyst, gives you a much better sense of really the credit quality of the company and looking at not only the utilization, but the ability to cover those payments.
So I led study abroad a couple of years ago, and we got to visit one of the credit rating agencies in London, and they acknowledged that they tend to be a little slow at updating their ratings. In fact, they were asked And the person that was presenting was asked, how often do you reanalyze? And they said about every 6 months. A lot can change in 6 months.
I can change.
Now, this was an analyst that actually did municipal debt and not companies, so they may not move as quickly. But also, we were there the week after the Silicon Valley Bank thing happened.
Oh,
AAA rated Silicon Valley Bank, and their assets and their liabilities had a very large disconnect. They had put short-term assets into long-term liabilities. Basically, they had taken people's checking account money and bought 30-year bonds to try to make it too basic. And they ended up in a situation where a lot of people wanted their money out of the bank, and they had to start selling bonds at a loss. And those bonds were being carried on their, I think they were being carried on their balance sheet, assuming that they were priced at par, even though they were about 30% discount to par.
which is
So,
why mark to market is a real thing.
yeah, you would if you done just a little bit of digging, and it's as easy to say Monday morning quarterbacking was. I understand that, but and I know right after that happened to Silicon Valley Bank, every regional bank was suddenly scrutinized, and it was a one bank unique situation,
Right.
which was a whole comedy of errors. Somebody needs to make a movie about that.
Oh, and I'm
So,
sure they will.
but that, I mean, and about 3 days after the company declared bankruptcy, all the rating agencies started cutting their rating. So pay attention to the numbers and not necessarily those letters they're putting out there for you guys. So, anything else you got to chime in on this? I just told my little
Nope.
personal story.
So, but I
Okay.
do, and I guess one last thing, you can create your own debt rating. So these are the ratios that I thought were very important. And this is the part of the art in finance as opposed to just the straight science. So really understanding what ratios are important to you and why, and what you're looking for is also part of doing this homework. And with that, we can say goodbye. And if you enjoyed this video, please hit like and please hit subscribe. And if you enjoyed these more shorter videos that are a little more direct on education on how to build some of these things, please let us know. If you have other thoughts and ideas for topics, please let us know, and we are open to constructive criticism. With that, thank you very much, and thank you, Dr. Rowe.
You betcha. See you next time.